We're halfway there. You may ask, halfway to what? Well, we're more than halfway through the year, and let's hope the second half of 2020 is going to be better than the first half. And that's what we're going to chat about in this episode of the Michael Yardney podcast, where I give you some ideas of what's ahead. Because clearly we're living in unprecedented times and unique times with the confluence of a number of major challenges which are putting stress on our economy, on our society, on the political systems, and on the housing markets. So I'm first going to give you some of my thoughts on what the second half of this year is going to bring. And then I'm going to have a chat with Pete Wargent about what's really happening with the financial system, with the housing markets and with housing stress, because a lot of people are concerned about what's going to happen after September when a lot of the support mechanisms are taken away. This is going to give you some insight from some people who've been around the block a few times to help you get some extra clarity and some certainty in these challenging times. So welcome to today's episode of the Michael Yardney podcast.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's most trusted property commentator who has once again been voted Australia's leading property investment advisor. That's the fifth time he's won a similar award in the last 7 years.
As I said in the introduction, we're living in unique times, with the confluence of a number of major challenges. I've never seen a trilogy like this before. A global pandemic, Australia slipping into recession, and increasing geopolitical and, in fact, local social unrest. Now, this means there's a lot of things to think about, both at the macro level affecting our country and its place in the world, and at the micro level, thinking about your own life, your security, your financial health, and your investment strategies. But remember, your investments, your business, your career, they all operate within a complex yet delicate ecology made up of people, resources, organisations, policies, procedures, and our physical environment. And all of these sometimes throw out some surprises at us, don't they? Now, this ecology is a finely tuned machine, and although it's flexible and it's resilient, it's got its limits. It's a bit like those jugglers at the circus with all those plates spinning in the air at the one time. Which ones are going to keep spinning and which ones are going to come crashing down? This means it's important to keep an eye on all those spinning plates and watch out for warning signs. Ignoring the warning signs of plates about to topple almost always ends badly. Yet I've seen rational, mature adults revert to childlike, covering their eyes type of behaviour, avoiding the scary potential realities. Now, you can ignore reality, but you can't ignore the consequences of ignoring reality. And yes, there's lots of pessimists out there, and they only see the downside, and that often paralyses them. And at present, they're out in force. We're getting all those so-called experts chasing a headline, and the media loves them because they provide great clickbait. These negative Nellies can only see the worst happening. They can see a major world recession, the end of our financial institutions, real estate Armageddon, meaning our housing property values in Australia are going to drop by up to 30%. And unfortunately, they're attracting disciples. I'm seeing a whole group of nameless, faceless people trolling me on the YouTube channel at the moment, hoping that property values are going to crash, and they're hoping that the rich baby boomers are going to give back their ill-gotten gains. On the other hand, there's lots of optimists out there too, and that's great. They only see the upside. And sometimes they get blindsided by the dangers that are only obvious in hindsight. Yet over the years, I've realised that the secret to success in business and in property is the ability to pursue the upside while keeping the downside in view so it can be managed. In other words, I believe I'm a realist, which is probably an appropriate word for a successful property investor. Now, sure, there's lots of downsides if you look for it, and I realise there's pain everywhere. It's fairly obvious that people, businesses, markets, financial systems, and even society itself is suffering. So which of those plates are going to keep spinning and which are going to topple? And if they topple, will they break? And if so, what will it look like? And do you have a plan for that? So not are only are they frightening contemplations, they're actually hard work thinking about all that and planning for that. But if you love the freedom that you've got to pursue opportunities, to own a substantial property portfolio, to build your wealth, to build your businesses or your professional practice, and to retain and enjoy the fruits of your efforts, you are going to have to put hard work in. That's what's needed. One of my mentors, Jim Rohn, said it really well. He said, if you don't design your own life plan, chances are you're going to fall into somebody else's plan. And guess what they got planned for you? Not much. So what's ahead? Now, of course, no one really knows what's going to happen, so it's important to analyse and anticipate possibilities and probabilities. Yes, the health crisis has led to an economic shutdown. We're coming out of that, but all of this has got the potential to create a financial system crisis, especially in other parts of the world, and that's what some of the pessimists are worried about. But I don't think that's likely to happen, particularly here in Australia. Australia's economic outlook depends upon the success or otherwise achieved by the government health authorities and our communities in suppressing the spread of the virus. Now, if the virus is contained like it looks like it's going to be, and the active caseload remains manageable, yeah, we're going to keep getting outbreaks. But as long as it's manageable, then more parts of the economy are going to reopen and a degree of normality is going to return to society, to our lives, to businesses and the economy. But don't be surprised if there's going to be setbacks as the year goes on. There will be. As our economy reopens, obstacles like the outbreak in Melbourne can be expected. They're going to keep coming at us. You see, there's no roadmap for anyone, the governments or anyone, to follow. So they're just going to have to respond quickly to the change in circumstances. But most of the bright folks I've been talking to and that I know agree that Australia is better positioned than any other country in the world to work its way through the challenges ahead. These people include the economists at all our major banks and institutions, as well as the Reserve Bank and the International Monetary Fund. And they all agree we're not going to have a V-shaped recovery like a lot of us were hoping for, like happened after the global financial crisis, but they do agree we're going to have a recovery. But this time round, we won't have China to take all our exports or buy our real estate or support our economy. So it looks like we're going to have a stepwise recovery as our economy opens up in stages. The economic results for the June quarter, which we just finished a while ago, will only be reported in September. And we're sure to see that we experienced a severe recessionary period in the second quarter of this year. But by the time those results are reported, it's very likely that our economy is already going to be well on the rebound, with more businesses opening and more jobs being created. Sure, some of our support systems are going to be taken away at the end of September, with JobKeeper and mortgage holidays ending. But I can't see the government pulling the rug out from under us. They're already looking at ways of supporting us in different ways. They've spent too much time, too much money, too much energy, and boy, a lot of publicity telling us how they're going to support us. So it's likely that the support's going to remain in a different way and in a more targeted fashion. Our governments have got too much of a vested interest in keeping our real estate markets liquid and buoyant because they recognise that consumer confidence is critical for our economic recovery. And they know one of the quickest ways to make consumer confidence plummet is for people to see the value of their homes dropping. So the government doesn't want that. And at the same time, our banks, they don't want to become caretaker of your home. They don't want to kick their customers out of their homes and be mortgagees in possession. They're currently well capitalised and they've got the ability to extend some of the loan holidays or to support their customers. So what does this mean for our property markets? Well, up to now, our markets have been remarkably resilient, but there's no doubt that overall, house prices will fall further. Looking back at previous economic downturns, there are a few lessons we can learn how we got through those. Firstly, negative economic shocks don't necessarily lead to severe decline in property prices. This was true in our last recession in the early 90s, when really only the Melbourne property market dropped significantly in value. I remember I was there at the time. I was part of it at the time. But I also remember it rebounded quickly. And similarly, during the global financial crisis, property values held up pretty well. Remember, 70% of properties are owned by owner-occupiers, and they're using them for shelter, not for speculation. And in fact, 50% of homeowners don't have a mortgage against their properties, and those with a large debt in general, those debts are in the hands of those that can afford it, considering how cautious the banks have been with lending policies over the last few years. Now, we're going to discuss this and the mortgage stress a little bit later on this podcast when I have a chat with Pete Wargent. What I do see, though, is that the number of property transactions are going to decrease. Well, that's already happened anyway, because discretionary sellers and buyers are going on strike. The other thing I see is that our markets are going to remain fragmented. Markets are always fragmented. There's lots of different segments. You've got to look at them granularly. But some segments, though, are going to suffer more than others. So while A-grade homes and investment-grade properties in our more established, affluent suburbs are likely to hold their values well, crunch time's coming for many of those off-the-plan apartment buyers because they're not going to be able to settle on the properties that they committed to a number of years ago when the economic conditions were very, very different. Of course, they weren't investing, they were speculating. They didn't think that, of course. Core logic has shown that more than half of those people who bought an off-the-plan property are now finding their property values below the contract price when the job's completed. 25% of those properties value in at less than 90% of the contract price. In other words, the purchasers have lost their deposit. And of course, lenders only do a final valuation of the property on completion. So even if you got a pre-approval, you can't anyway get a pre-approval years ahead, months ahead, but lenders only value the properties on completion, and if the valuation is lower than the contract price, they can either refuse the loan or they can ask you to put a bigger deposit in. And many of these investors just won't have the deposit. Unfortunately, that means some investors are going to be financially ruined. Others will hold dud properties that are likely to become the slums of the future. Now, some investors may lose their deposit, but you know, of course, that the off-the-plan sellers, the marketers, the developers, can chase the purchaser because they've signed a legal contract to settle and ask them not just for the lost deposit, but any extra losses that they've got if they on-sell the property at a lower price later. But the truth is, off-the-plan properties were never good investments. They've got no scarcity. In general, they're in the wrong locations. They've got little owner-occupier appeal. They're too expensive. There's too many fingers in the pie with marketers and advertising costs and marketing costs taking significant margins. And over the last years, they've been dogged by poor quality construction and they've all been tarred with the same brush. So, off-the-plan properties are going to suffer. Similarly, many young families have overcommitted financially to their new home in the outer suburbs, and they're going to feel mortgage stress. So overall, some parts of our property market are going to do well, and others are not. And on balance, I think property values are going to fall, but not all properties are falling in value. Some are holding their values really well. Of course, our rental markets are going to suffer, as many of those who lost their jobs in industries such as hospitality, services, arts and entertainment, many of those were younger people, and most of those were renting. At the same time, we're seeing fewer overseas students coming, and this will affect the CBD rental apartment markets. And with fewer overseas tourists and even local tourists, a lot of the properties were previously on Airbnb have now been placed back into the general rental market. So more properties on the rental market, fewer tenants means lower rentals, higher vacancies, particularly in the CBDs of our capital cities. So what does this mean for our property markets? At the beginning, I said there were many plates spinning in the air, but as a realist, I believe very few of these are going to topple and break. I think when we look back in a year's time, we're going to be in a much, much better position economically, financially, and health-wise. And I also know that some of those cashed-up home buyers and investors who are going to take advantage of the opportunities the current property markets present are going to look back in a decade feeling very smug, just like those who took advantage of the opportunities during the global financial crisis. But there are going to be challenges ahead, and you can't just buy any property, as I was explaining. Now, in a moment, I'm going to be having a chat with Pete Wargent to talk a bit about what's going to happen to our property markets after September and a bit about mortgage stress. But before I have a chat with Pete, I want to remind you that if you are looking at getting involved in the property markets at the moment, as I said, there's so many plates spinning. Why try and do it on your own? Why not have a chat with my team at Metropole? Go to metropole.com.au because a lot of us there have been through a number of these property cycles. We've got the perspective to answer many of the questions that you are likely to have about the property market. Sometimes it's just a chat. Sometimes we put a strategic plan together for you. You may want to use our buyer's agency, our property management, our renovations, our wealth advisory, financial planning, development services. We've got a range of services. I don't know what your needs are, but I do know that we've won 3 awards in the last 18 months as Australia's leading property consultants. We have no properties for sale, so we'd love to help you. Go to metropole.com.au or give us a call at 1300 Metropole. We'd love to help you decide what to do by giving you some clarity, some direction, and some certainty in these challenging times. What's really happening with mortgage stress? Are we going to fall off a financial cliff in September? And will hundreds of thousands of Australians have to sell up their homes? They're going to have difficulty coping financially. Now, I'm not surprised if you're confused about this because there are so many conflicting messages in the media at present. So to get a better understanding of what's going on, we're going to have a chat with Pete Wargent today. Now, if you're a regular listener to this podcast or a reader of Property Update, Pete needs no introduction. But for those of you who don't know him, he's a prolific author, and by way of background, he's a chartered accountant, chartered secretary. He's got financial planning diploma. But he's not just a theorist. He's actually used a long-term approach to building businesses, investing in equities and owning properties to develop the financial independence that most people would love, but he did it in his 30s. So welcome, Pete.
Pleasure. Always good to be here. Thanks, Michael.
Now, Pete, you don't have to look too far to hear that people are concerned about the heightened risk of housing stress. They quote things like the rapid rise in house prices. You know, house prices in Australia went up 90% since 2005, but that's in part due to falling interest rates, but they've also suggested that house prices have outpaced average wages growth, which only went up about 65% in the same time frame. Others are worried about that high level of debt in Australians. Australians have taken on too much debt. And now COVID has created an economic catastrophe that they're wondering what's that going to do? And of course, there's that concern that the government's going to pull the rug out from under us in September. Lots to discuss at the moment, Pete. But I think a bit of this is going to have to do with how soon our economy gets going and how soon we get back to a more normal life.
Yeah, completely. So, yeah, there's lots to talk about. And the interesting thing is that it's a really it's a movable feast and things are changing quite rapidly in real time. So, yeah, lots to discuss there. I mean, the good news is in July that things are looking a lot better than they were in mid-April when the ABS first started surveying households on the impact of the shutdown and COVID-19. So things have obviously picked up and Australia has done a fantastic job of containing the coronavirus, but still some challenges ahead, of course.
Well, you're right. Just recently, the Australian Bureau of Statistics brought out another survey, and they've actually shown that our finances in general have improved. Around 2 out of 3 households now report the state of their finances have remained the same, but another 16% actually said they've improved. And this is only in the early days of now moving out of the lockdown, Pete.
Yeah, completely. So when we went back to April, consumer confidence was really low. A lot of households said that they were likely to take a hit from lack of activity, but the fair credit where it's due, the government stepped in with 2 particularly large stimulus packages, a total of $130 billion. The fiscal support has really swung into action and made a huge difference. Now, as you mentioned, there is a September sort of cut-off for a couple of things. One is the JobKeeper support, and the other is mortgage holidays that people have taken. So we've got about $176 billion worth of residential mortgage holidays that will come September. People will then, beyond that point, have to start repaying their mortgage again. So there are still some hurdles to come, but the government's come in with an unprecedented stimulus package just to tide us through and build that bridge across to the other side.
More than that, they've actually put their reputations on the line saying that we're going to do anything and everything we can. I can't see them pulling the rug out from under us after having gone out in public and spent so much time, effort, energy, and emotion in getting us there to stop everything straight away. But it may look a little bit different after September, Pete.
Yeah, so one of the interesting things was there was actually an accounting error, the sort of thing that gives me cold sweats thinking back to my days in professional practice. It's a bit of a convoluted story, but a lot of businesses had written down 1,500 in one of the boxes being the actual fortnightly payment. The data was, when it was collated, was actually mistakenly extrapolated out as being the number of employees that they were going to be claiming for those businesses. So effectively, what came out of that is two things. One, the economy is in a lot better shape than was feared back in April. But secondly, the cost to the government budget of the program is going to be about 60 billion less than was previously thought, which is a stupendous sum. So I think what will happen come September, there is this sort of theory of economics that when you've got a known risk like the September cliff, the more that people talk about it, the less likely it is to happen, or the more the impact is dampened. And I expect what will happen is the government will put in place income support measures for the hardest hit industries. So I'm thinking things like arts, tourism, and some of those hospitality industries, possibly retail. So instead of just dropping off a cliff in September, the government does now have the capacity to smooth things over. With regards to mortgage holidays, I think something similar. There's very little incentive for banks and lenders to foreclose or repossess properties in Australia. So where there are instances of people struggling to repay mortgages from October onwards, most likely what we'll see is potentially the return of interest-only lending, maybe the extension of loan terms for stressed borrowers. I don't think we'll see a sudden spike in defaults. I just think it's a known risk, and nobody has an incentive to send borrowers to the wall.
More than that, the government knows that consumer confidence is going to be very important in getting our economy moving again. And consumers feel confident when they know that their biggest asset, their home, is secure. So they wouldn't have any interest in allowing many mortgagee sales to occur. Now, we know a lot of people have lost their jobs, and that's terrible if that's happened to you. In fact, I saw some information today from Boston Consulting that said that the ATO confirmed that 950,000 jobs were lost between 14th of March and 2nd of May. That's a little bit bigger than some of the other estimates. But they've also, Boston Consultant was expecting about half of them to be re-established before December. So it's going to be a stepwise increase. It's not going to be a V-shaped recovery, but certain industries are coming back sooner than others, and over time others will come back. And you mentioned a while ago a couple of the others, the media, the arts, travel, hospitality, they're going to take the longest to get back to normal. But interestingly, Pete, a lot of people in those industries tend to be the younger people, and often more tenants as opposed to homeowners.
Yeah, so I think if you look at the composition of the labour force, it's changed a lot since our parents' generation and what they were used to. People used to think of a job as being 40 hours a week in the local factory or possibly in an office for the white-collar workers. These days, there are a lot more part-time jobs. There's a lot of consulting roles. There are some people who choose to work part-time. It's much more fluid than it used to be. And I think broadly, if you look at it, we had 13 million, a record 13 million employed in the lead up to the COVID crisis. That figure's fallen broadly to about 12 million. But as you said, when the economy reopens, a lot of those jobs will come back, especially in some of those fringe type roles, part-time jobs, and some of the people who are sort of on the fringe of the labour force. So a lot of part-time workers, younger workers, sometimes mothers who were only doing a day or two a week of work. So yeah, in terms of impact on the housing market, it definitely has an impact just because of the sheer numbers we're talking about. I suspect the mortgage stress won't feature as highly as people think it will, but the definitely will be some issues in the rental market. So for some landlords, I think they will find that their tenants, in some instances, struggle to make payments, especially beyond September. So some of the pain will get shared around a bit. Generally speaking, and this is what ANZ's report found, is that most of the people who've been sort of dropped out of the labour force are often younger or lower income households or part-time workers. So the impact actually on mortgage repayments won't be as great as possibly was feared back in April.
Sure. So there are some people out there in the media telling us how people are selling up their houses now, even before the September, to get in before we fall over the cliff. But the bottom line is that in general, the debt is in the hands of people that can afford it. Now, there is no doubt that some first homeowners have overcommitted themselves and having financial problems. There's no doubt that some investors have overcommitted themselves and bought the wrong sort of properties, like those who've purchased off the plan and now can't settle. But it's generally older people and those who can afford it more that are the ones who hold the vast amount of housing debt, Pete.
Yeah, that's right. That's exactly what the figures show, is that if you look at it, if you break it up by income quintile, especially owner-occupied debt, it's overwhelmingly held by people in the fourth and fifth income quintiles, i.e., the top 40% of income earners. The other thing that's really changed is that, if you went back to, say, 2007-8, when people took out a new mortgage, they were paying more than half of their income, their gross income, on servicing a new mortgage. Now, interest rates have absolutely plunged since then, and we've had another 5 interest rate cuts in 12 months. So these days, a new mortgage might be at, say, 2 or 3%. So the share of income now on servicing a new mortgage is closer to a third. For existing borrowers, that's really taken the pressure off the ability to refinance down to much lower mortgage rates. I mean, that really takes the sting out of a mortgage debt.
Now, with talk about property values dropping, there are some segments of our property market that are going to suffer. I only read recently that about half of people who've committed to purchase a property off the plan and were meant to settle in the last little while couldn't settle because the valuations were so low and they didn't have enough income, or the banks wouldn't lend them to settle. So those big high-rise towers that were already tainted with their construction challenges have now become maybe the ghost towers in the slums of the future. A lot of young families are having trouble settling on new house and land packages in the outer suburbs, even though this is now going to be that new grant that started all over again that's going to help some people get into it. But in now more established middle ring suburbs of all our capital cities, a lot of people's mortgages have been paid off years ago, Peter, haven't they?
Yeah, and in fact, if you look at the impact on prices, it's been pretty interesting. I don't know the Melbourne market as well as you do, but quite clearly from reports and from people I've spoken to, some suburbs have been really strong, even in the face of a shutdown economy. And I guess that's just, as you say, in the more established areas, very few forced sellers at the moment because we've got record low mortgage rates, serviceabilities at multi-decade highs, and also even for people who've gone without work for a period of time, the government stimulus measures have covered them off. So I think the areas where there's a potentially there, you mentioned a real potential trap for first home buyers, and that is the government's rolling out another 10,000 places for the low deposit borrowers, the first home loan deposit scheme, and people getting sucked in by the incentives to buy brand new property. And this is into the peak of a construction boom where we know there's been some construction quality issues. People should think very carefully about the incentives to buy high-rise apartments or house and land packages where there's no scarcity in the product. And sometimes the construction quality is questionable as well. We know from history that often leads to challenges or trouble down the track.
No doubt about that. Recently, I saw a headline suggesting that these first homeowners should buy the properties that the investors are getting out of in the high-rise towers. No, because even if this isn't going to be your final home, it should be the stepping stone to the next place and the next place, or buying an investment in the future. So you need to sort of property that's going to give you capital growth as well. Not going to get those in those high-rise towers. So overall, Pete, you can't see, like me, a real issue coming into September. And by the way, it's the end of September, so we're really talking about October before these things will happen. I think by that time, our economy is going to be in a much better condition.
Yeah, it's an interesting one because, of course, stories of financial stress and mortgage stress, it's a real media favourite, and it's guaranteed to generate interest and clicks. But we've seen that story run consistently for about 14 years now. We have record mortgage stress, record financial stress. The people who often put out those reports have a bit of a vested interest. The ABS survey that came out, the most recent ABS survey on household impacts of COVID-19, showed that actually, we came into this crisis with bankruptcies and insolvencies at quarter-century lows, and they've shown that financial stress is actually at a very low level, and probably about 9 in 10 households have got a pretty comfortable buffer. Seems like about 3% of households potentially will face challenges over the coming months, but that's not actually that unusual. So, yes, of course, the shutdown is going to have some detrimental impacts, and some businesses will close and all the rest of it. But actually, record low mortgage rates, record low interest rates, and the government stimulus, I think that will tide us over. And at the end of the day, Australia's been remarkably lucky, or maybe just it was good management, I don't know, but we've done a tremendous job of containing the virus. So the ability to reopen the economy and get people moving and back to work, that's a real blessing for Australia. Plus, of course, it will make Australia one of the most attractive countries in the world and perceived to be one of the safest when we do move to the other side.
Well, the International Monetary Fund has changed its forecast. It's actually suggesting that the world economy in 2020 is going to be worse than it initially thought in April. And in 2021, it's going to pick up, but maybe not as much. But the rising star was Australia. They've suggested that we're going to do better than any other developed country's economy. And that's in line with the Reserve Bank's forecasts of rising economy in the second half of 2020.
Yeah, that's right. And I think as well, we shouldn't underestimate, only really 2 countries are going to come out of this crisis with an elevated reputation as desirable and safe economies and places to live. And that's New Zealand, which has done a tremendous job, and Australia, of the developed economies. I think when people are in some of these perceived less stable environments like Hong Kong, or even just people in Asia who are thinking of going to potentially the US or other countries like Canada, I mean, Australia would now be right at the top of that list. So once logistically Australia can open the borders again, the demand for Australian visas coming to work in the Australian economy is going to be as high as it's ever been.
So there's good times ahead, and if you look for it, there's lots of good news in the media. On the other hand, if you look for it, there's lots of bad news as well. And that's one of the things that concerns me, Pete, because consumer confidence is what's going to drive our economy. If consumers are confident about their financial future, about the state of the Australian economy, they're going to spend again. But until they are, despite them going back to work, they're going to stash their cash. They're a bit more likely to be cautious until they see a big light at the end of the tunnel.
Yeah, so consumer confidence has bounced tremendously over the past 10 weeks, but it's still actually, in historic terms, still below the long-run average. So there's definitely a way to go. Interestingly, in terms of Westpac's surveys, they actually survey households on whether it's a good time to buy a dwelling, and those figures were at very low levels in April, but that's bounced by 35% in record time. So that's also backed up by CoreLogic's figures on people seriously searching for a property to buy. So there's clearly a lot of pent-up demand, as you might expect, I guess, when mortgage rates are at the lowest level in history.
I think there's also the different stages of going through grief and stress, and that's what we all went through in March, April. The disbelief, the shock, the anger. And now a lot of us are just realizing we've got to get on with our lives. And so that initial economic shock, the initial consumer confidence shock of March and April has now started to pick up. So there are some good times ahead, and we'll be getting together regularly to talk about them. Thank you very much. Before we finish off, Pete, if people want to get more of your regular content and the great charts that you bring out every day, where should they head?
Best place is my free daily blog, Pete Wargent Blogspot. And if you're interested in a couple of videos a week that I usually put out on my thoughts on what's going on in the world, try go nextlevelwealth.com.au.
Now, we're going to put those links in the show notes, and regularly you've got articles on Property Update. And lastly, your new book, which should finally be in the bookstores once the printers come out of their COVID cocoon. Tell us about that one.
My latest book is called Low Rates, High Returns, and I think the topic is self-explanatory. It's navigating the challenges of low interest rates for people who want to manage their own money, especially in stocks. And that's a book that I've co-authored with Stephen Moriarty. So, yeah, as you said, it was due to be out earlier in the year. A bit of a delay thanks to COVID, but we'll get there in the end, and it'll be in the bookstores fairly soon.
And you've got a podcast all around that as well, and I enjoy listening to it every week, so I'll put a link to that in the show notes as well. So lots of ways to keep contact with Pete Wargent, who's my most regular guest here on the Michael Yardney podcast. Thanks for your time, Pete.
Pleasure. Thanks, Michael.
I started off today's show explaining how we're living in unique times. I hope now you've got a slightly better understanding of how to traverse the second half of 2020. And if it did help you, I'd really appreciate it if you passed the message on to somebody else, because that's really the purpose of this podcast, to make as many people as financially literate as possible, to give them the choices and the independence in their life. Now, you can either tell somebody about it or use the share button on all the podcast apps or social media. And I really appreciate how many of you are doing this, because our audience is growing exponentially. We've had significant growth over the last couple of months. That I got a recent letter from, or actually an email from our podcast hosting service saying that we're in the top 40 fastest growing podcasts in the business sphere globally. That really impressed me. And I thank you for taking the time to listen to me. I love putting these shows together, and I particularly like the great reviews I keep getting. And if I read yours out, as I'm about to for Jenny and Sam White, just email me, michael@metropole.com.au, and I'd love to say thank you by gifting you one of my books. Now, the report left by Jenny and Sam White on Apple Podcasts recently said, "Hi Michael, love the podcast, listen to them religiously, have been for a number of years. They're a wealth of information, not only on property, but more importantly on mindset. I really appreciate all your efforts. It's great how you're giving back to the community, which to me is priceless. Keep up the fantastic work. Looking forward to working with you soon." Well, guys, I look forward to working with you too and helping you along your journey. And as I said, email me, michael@metropole.com.au, and I'd love to say thank you by gifting you one of my books. Now, I'll be back again real soon, but if you want to catch up with me in between the twice-a-week Michael Yardney podcasts, just look out for me on social media, or, of course, subscribe to my daily newsletter. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael, but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?